Hello everybody, welcome back to another podcast of Investor Motivation. You are with Amy Lehmann and Robert Goudie.
G'day, how are you, Amy?
Great, how are you?
Good, thank you. Thank you for everyone for joining us. What's been happening in the world of Amy and consorting private wealth?
Busy as always. It's still great to see all the podcast listeners booking in for appointments. They're listening, they're booking in and just getting some education, and sometimes that's all people need. Sometimes people really do need some financial advice, and it's just great to meet everyone around Australia.
Yeah, it's been really cool. It's been been really lovely just to see so many different scenarios, because we are very much used to scenarios regarding business owners and farmers, which are a big part of what we've dealt with over many years. But chatting to the people in Sydney and Melbourne and Hobart, and it's
fun.
Different scenarios, and chatting with people is always the best.
Yeah.
What are we chatting about today?
Today we are chatting about, and based on a comment left on one of the previous YouTube videos, so shout out to that person that left a comment and gave us something we know that will interest you to talk about. We have previously covered off on retiring on $650,000 as a homeowner couple and how you might go about doing that. So today we're going to cover off on retiring on that same figure, $650,000 as a couple, non-homeowners.
Non-homeowners, yep. Makes a pretty big difference.
Well, it helps with Centrelink for sure.
Yep, helps with Centrelink, but also there is rent, so there's the downside.
Yeah.
Yep.
We'll see how it all plays out.
Yeah, that's right. So we're going to make some assumptions there, and when we've done the rent numbers, obviously we're in small town country Victoria, which is very different to perhaps renting in the major capital cities. So hopefully I've got an average, a bit of a medium when we do that. But before we kick off, acknowledgement of land, thanks.
Yep. On behalf of the Investor Motivation podcast, we would like to pay our respects to the traditional owners of the land on which we are recording, and pay our respect to the elders past, present and emerging.
Cool. The scenario where people have been, I suppose, renting, in retirement, how does that happen in Australia? And it's probably going to be more the norm moving forward, isn't it?
Well, housing prices have gone up so hard, and there is a lot of wealth tied up in real estate, which is a lifestyle asset when it's your own home, that these people do need to release some cash back into their, balance sheets. And the biggest way to do that is the downsizer and selling your own home. It may be something more common that we see moving forward.
Yeah, so I think that'll be for people that have, paid off their home, they've brought up family. That takes a lot of effort, a lot of income, and they haven't had the opportunity, just because their age and that superannuation wasn't about for their whole journey, that realising the equity in the home will be part of that. Now that can be done one of two ways, but in this scenario, this is where someone's made a decision that we're going to sell the home.
Sell the home, free up some cash flow, and we're going to be having $650,000 as the financial assets with this couple. So whether that is super or cash, whatever it might be.
Great. And we've also, in our assessments, and we've used our projector, which we do all the time, and we've got that beside us so we can alter the numbers to suit. But of course, the other option, rather than selling, that we're not factoring here, is that people can use the home equity release scheme, where you just grab a bit of the equity out of your home to top up your pension. So
that off the cards, because there is no home to release that equity from.
Correct.
Yep.
So we're not talking about that one, but that is another option that people have. So we've been very selective in terms of the timing. These people are age 67, which means they are eligible and they are retiring at age 67. So they've worked all the way up to then. As a couple, they're both eligible for the age pension. What are the assets, test limits and so on for non-homeowner? Because it's different to homeowner.
So for the full age pension, assets tests for the non-homeowner couple is $722,000.
Right.
So any assets above that is when it starts shading out.
Right.
The higher threshold is $1.297 million. So above that, no age pension at all.
Okay. And for people's information, people that own their homes, the assets test threshold is $252,000 below those numbers, I believe, approximately. So this is where to be a non-homeowner, you do get that extra 250 grand of assets you can have before you were affected or cut off. As in affected by, I mean a reduction.
Yep.
In the
shading out.
Yeah, and that is a reduction of $3 for every $1,000 over the lower limit.
Yep.
And it cuts out once you get to those higher limits. So obviously there's a bit of a free kick there, but quite often that doesn't really work. That valuations of most people's homes are well above that 250.
Absolutely.
So it's not really a strategy that we look at to deliberately have someone being a non-homeowner.
No, not at all, especially with that third safety net of the home equity access scheme, because that,
Yes.
like you say, if someone's home is worth 600,000 and 250,000 is the difference of non-homeowner and homeowner, there's an extra 400,000 essentially to the estate if anyone else.
Yep.
Yeah.
Understand. So one of the other major factors that will affect our figures here is how much rent is.
Yes, that's right.
So what I've done in the calculations is I've assumed that they're paying approximately $600 per week.
Okay.
Fair enough, Amy? Do you agree?
Well, yeah, I think in our small town it might be a bit less than that, but in the cities it's probably substantially more, so it's probably a great average.
So that's a midpoint.
Yeah.
So what I've done there is when we've done our calculations, so I've essentially got spending on rent is $20,000 per year. So that is essentially it's 30 grand at $600 per week, thereabouts, less 10,400 in rent assistance.
Yep.
So people would, paying $500-600 per week would get the maximum rent assistance, which is about 10.5 grand per year. So that is the advantage. The other advantage that I haven't factored in is the cost of owning a home. Can be expensive because you get rates.
Yeah.
Water service charge.
Yeah.
Insurance. So there's other things that you do save, but we're not going to factor those in.
Yeah.
We're just going to assume net after 30 grand in rent, less rent assistance gives us a net cost of $20,000 on top of the amount that they get to spend.
Yep, and we've put that in at 60,000, which I think is a really good figure because, like you say, those as for retirement standards we always relate to are generally for homeowners.
Yes.
And that comfortable spending for a couple in their first half of their retirement is about 73,000.
Yep.
So shave a little bit off for those extra maintenance costs that renters don't have to pay.
Yes.
60 grand is probably a nice comfortable retirement standard.
And this is where there's got to be, I suppose, some compromise.
Yeah.
Yep, that it's, but also the one thing that we haven't chatted about here is 60 grand, and I've done the life expectancy numbers through to age 85. Not that I believe that a couple retiring at 67 now will both automatically die at age 85.
Yeah.
It's just someone will.
Yep.
More than likely. And what happens then, Amy, once that does happen?
When one goes, that takes it from a couple non-homer to a single non-homer, and that's the Centrelink benefits coming in that really, really reduces.
Cool. So you go from getting, full pension as a couple is about 45 grand a year. That comes down to
about 30.
About 30. So, and
that's
and you're still
when the rent is still at 20 and
exactly, rent stays the same. Electricity and all the other stuff all stays the same. So that's where it gets tough for the next, for the single pensioner, where your income is just completely smoked. So what do those numbers look like, Amy? If we go down the bottom and see, so obviously we better talk about the return assumptions that we use as well.
So we've put this couple in a Model 3 portfolio, which is about 60% invested in growth assets and 40% in conservative assets. Based on that, we have a base case return scenario. So for the first 10 years of these funds being invested, the return is 4.8%. And we also look at a pessimistic scenario. So if, shit hits the fan, if I can say that on the podcast.
Yes, you can. And markets crashing, correcting are normal parts of the cycle.
Yep. So for the average 10 years under the pessimistic scenario, the return is 1.6%, which is quite a pessimistic scenario.
Yep.
And then after the first 10 years, the return for both scenarios defaults to 4.8%.
Cool. And we are taking into account inflation as well.
So that, 60 grand each year for income requirements does go up with inflation at 2.9%.
Cool. But less 1%, so we're predicting that people's income needs will reduce over time.
Yep.
Okay,
As we get
so
older,
there's the lay of the land, and we haven't taken into account any inheritance or anything like that, which can happen, of course, but if it was expected, we would factor that in for our client projections, because that definitely helps how we, gives us the confidence to spend more money now in the first part of their retirement, rather than being, you may want to spend more than 60 grand a year, and if you know that you've got a couple hundred grand coming in the next 10 to 15 years, that can, and we'll throw these numbers in and give you the numbers as well.
Yeah.
But at age 85, what the numbers look like under the base case?
So under that base case return scenario, there's $229,000 left at age 85. So if one was to pass away, the remaining spouse would still get their almost 30 grand of Centrelink benefits.
Yep.
Plus have 229 grand to lean on.
Great. With another 10 years to live, 20 grand per year, excluding any returns, I would personally be really comfortable for that scenario.
Yep.
But under the pessimistic, what if it goes to hell in a handbasket and it's not quite as good?
Yep. First 10 years, we have a big correction and that average return really reduces. The pessimistic at age 85 is $63,000.
Okay. Now that gets leaner, where I have less comfort that's an ideal scenario. So what if we're not happy with the pessimistic, I would like to see obviously a little bit more than that.
Yeah.
I'd like to see at least 100 grand. And my thinking there with 100 grand is that someone gets to age 85, living off, a single pension is just going to be far, far too difficult. Oh, of course, we've got rent as well.
Which we actually did cut out.
Yeah, which we cut out at age 85, but it's going to be, rent will still be there. So we're going to need more than 60 something grand. So what's got to give? And it's got to be the income. So if we go back to the projector, Amy, and see what it looks like, if we reduce the spending rate, which is quite often, in my view, the fun rate. So we're actually going to reduce the amount they spend from 60 grand down to, say, 55. And what do those numbers look like?
It does help that pessimistic go from that 60 to about 150.
Okay. They're the things that, it's not ideal, but we've got to make sure that whoever gets to that point in time, who's the single that's left, has a reasonable lump sum. Otherwise, it's going to be, they will not be able to afford where they live. They will have to downsize. Obviously, there's enough insecurity around renting. Imagine doing that as a mid-80s. Generally, it's going to be the lady.
Surviving.
Yeah, it's going to be exceedingly tough.
Yeah. Alternatively, rather than reducing spending, we can also change the way we invest. We always talk about that's the most important way. To grow your wealth.
So how would we suggest we do that, Amy? We're talking about having more growth assets.
Yes.
Which obviously means more volatility, but at age 67, retirement is long. It may not be the end of the world.
No, and you do need to account for the last remaining spouse's life expectancy. So from 67, we want, at least 20 plus years.
Yeah.
And for both, really, we want to project conservatively and have it remaining for a long time. So just for example, we'll go from Model 3 portfolio, so that was 60% growth.
Yes.
And we'll go all the way up to Model 5, which is just for, the showing of figures here.
Yep.
Model 5 portfolio, which is about 95% growth assets.
Great. So we've got a lot of money. We've nearly got all the money into growth assets. So the share markets around the world and just a little bit in cash. So volatility goes up.
Volatility goes up, but the base case does also go up.
Yep. And the pessimistic one goes down because of that potential for more volatility and corrections and crashes.
Yeah. So under the pessimistic scenario, it does drop to 11,000 and the base case goes up to 286,000.
Cool. So that just broadens the extremes of the Monte Carlo simulations that this projector is taking into account. There are 2,000 plus simulations happening in the background here.
Yeah.
So can we go for a middle ground there?
Yes, we can.
So that's a model portfolio 4, which sort of gives you 75% growth, 25% conservative.
Yeah. So base case for age 85 is then 257,000. So a little bit less than the one before, but not bad really for an extra.
Yes.
Yeah, 25% in conservative, and the pessimistic scenario sits at 37,500.
All right. Again, that pessimistic one doesn't fill us full of rainbows and sunshine, but you've got to improve the scenario overall. You need to let your money grow. Being too conservative is a bigger risk than having too much volatility.
Yep, absolutely.
Yep.
Volatility is inherent, and
Yep. And when we've got a investment time frame of 30 years from age 67, with the changes of health and medical, people getting to mid-90s will be very common occurrence in the decades ahead of us.
And the amount of people already that come in and say they've still got parents alive celebrating their 100th birthday or 103, it's absolutely amazing.
It is already happening now. All right, let's get a little bit more positive, Amy, and just say, well, at some stage in the next 10 years, there is some inheritance of $150,000.
All right, let's go age 75. If we're 67 now, did you say 100?
$100,000.
100,000?
Yep. Or the rich sibling.
Too many zeros.
Too many zeros. 1 zero makes a really big difference.
It does.
Okay,
so $100,000 coming in at age 75, and I've reverted back to the Model 3 portfolio here. Base case scenario at 85, there is 337,000, and pessimistic scenario is 175.
Cool.
So that.
Yep, and that's back at that $60,000 per year. That obviously would make things very comfortable.
Yes.
If that was to happen. But anyhow, the initial scenario was that there was no inheritance. So in my thinking, what I would be doing is perhaps increasing from model portfolio to more slightly growth orientated so it can grow more, and possibly reducing the 60 grand down to say 57.5 or something like that.
Yep.
So a bit of a compromise on both, that spend a little bit less and then invest a little bit more growth orientated, and then let's see how that looks.
At age 85 under the base case, you're sitting on 305,000.
Yep.
And the pessimistic age 85, 82,000.
Good. And it's worth noting too that we're talking about base case and then the pessimistic. There is actually an optimistic one. We know that a lot of these portfolios have done well in excess of the numbers we are quoting.
Yes.
But again, we want to be conservative with our figures.
Absolutely.
Yeah. Excellent. So it can be done, but there's just compromises.
Yeah, and there's strategies, not that it would really need to be all that important for this scenario, but if you are even getting an inheritance and you don't want to lose Centrelink or things down the track, there are strategies to put in place to reduce your accessible assets if needed.
Yeah, and obviously with obviously Centrelink, here that it's really not, it's the full age pension.
Yeah.
So where people have 700 and above, and there's obviously starts to be reductions, there are complying annuities that where 40% of the annuity is excluded from the assets test. There are the not so exciting funeral bonds where you can put in how much, Amy?
15,500 each.
It's 15.5 now.
Yep.
Cool. So that's been indexed. So of course, the 15.5 grand in a funeral bond, you won't need all that for your funeral, but it does bring your assets test down, and then that's worth for a funeral bond. Every 10 grand you can put aside, that's 7.8% return in pension alone.
Yeah.
So whilst I'm a bit sarcastic in saying really negative thing to do to prepay for your funeral, it does provide a good pension result.
It does. Better than bank interest.
Yeah. Can we get a funeral bond out once we've paid the bond?
I was going to ask you that, but I didn't want to put you on the spot.
Well, I've put us both on the spot because we've set up many funeral bonds over the time, but we haven't say, hey, can we put our money back now that we've enjoyed the So probably the answer is no.
No, but I was thinking more upon death, if you don't spend 15.5 grand on a funeral.
That would not be lost.
Yeah,
Yeah, surely not.
Surely,
Yeah.
with the estate.
Yeah. Now, I don't know what a funeral is worth, but that would not be lost. It would go back to the estate.
Yep.
Yep. Fantastic. All right. So there's other strategies sort of within that, but for this case study, which was a bit of fun, there are strategies to maximise Centrelink, and we always take the saying that we want to, I suppose, spend the government's money first before yours. So that's something we've always tried to do. And for one of our next podcasts, what we may look to do is, what is the ideal amount that Amy and I think, is the amount of money that people should aspire to having in the future at retirement, where we're not talking Centrelink and no one can touch it.
Yeah, it's the untouchable figure.
Yeah, just it should be no stress about how much you've got, will it last, any of those sort of numbers. So what is the ideal number? But I deal with lots of people that have the ideal number and they stress about money tremendously.
Yeah, that's right.
Yeah, where the person that has no money, has their home, gets a full age pension, there is zero stress.
Yeah.
They are very happy people. Cool. Thanks, Amy.
Thank you.
Good. Thanks for everyone joining us. If you want to find out more from Amy or myself, Amy is The Wealth Diaries on TikTok and Instagram. I'm Rob Goudie on both those platforms as well. Yeah. Please check out our YouTube channel. That is Investor Motivation, same as the podcast. The podcasts are there, but there is probably another 600 videos of so increasing knowledge and education stuff there. It's all based around knowledge. Increasing knowledge and education.
Yeah, and as always, it is for you guys. So please comment on any of those platforms as well with things that you want to hear, because we want to tell you what you want to hear.
Cool. Thanks, Amy.
Thanks, everybody.
Cheers. Bye-bye.